What a crazy week it's been. President Donald Trump announced tariffs on Canada, Mexico, and China. The stock market went down, Bitcoin dropped, and people called Mr. Trump crazy for imposing these tariffs on our neighbors. But then Canada caved, Mexico caved, the US canceled the tariffs, and the markets went up again. Now you're all caught up, except there's a 30-day delay on the tariffs now, and they could be coming back. So, when they do, I want you to understand what's happening because a lot of people are scared right now that this will make the price of stuff go up. But I'm here to tell you that's not always the case. If you're someone who's just trying to invest their money and you're trying to understand what the heck is happening, I'm going to break down the trade war, what it means for the economy, and what history tells us about similar situations. But I also want to go deeper because behind this trade war is something so much bigger: the fate of the US dollar and the possibility of something called the Plaza Accord 2.0. And what that means for stocks, real estate, Bitcoin, and your portfolio. Because the truth is, right now, on the global economic stage, there's a game of 4D chess being played right in front of us, and that's what I want to help explain. So, let's get into it. Now, by now, you probably already realize that the United States has won the trade war between Mexico and Canada. They're already putting more agents on the border to stop organized crime and drug trafficking. And by the way, here's how you can tell which country is going to win a trade war. You can measure how much a country's paycheck relies on another country's trade. For example, Canada's exports as a percentage of their GDP with the US is 22%, and for Mexico, it's 35%. But US exports as a percentage of its overall income is 1.5% from Canada and 1.2% from Mexico, meaning Canada and Mexico rely a lot more on the US than the other way around. So, in a game of chicken, the US is going to win. Now, one of the biggest misconceptions about tariffs is that they lead to inflation or prices going up. I'm sure you've seen those scary headlines, but they're wrong. If you ever study economics and people like Milton Friedman, who's considered to be one of the most respected economists of all time, he said that the only entity that can create inflation is the government. No one else can make prices go up other than those who possess the power to create money.
They don't produce inflation for one simple reason. They do not own a printing press on which you can turn out green pieces of paper. Consumers don't produce it. Producers don't produce it. The trade unions don't produce it. Foreign sheiks don't produce it. Oil imports don't produce it. What produces it is too much government spending and too much government creation of money and nothing else.
Now, thankfully, we have Elon Musk and Dogecoin, which are meticulously analyzing government spending and cutting it. And that's really good because it allows us to make the government smaller and to cut corrupt, inefficient spending, which allows the country to rely less on its citizens for income, aka taxes. So, by introducing strategic tariffs and cutting government spending, it's possible for the US to lower prices and spend less on taxes. And if you want a deep dive, there's a video by Anthony Pano which you should check out that talks about this. There were 3 specific examples of how President Trump's 2018 tariffs actually helped create more jobs by forcing companies to make more stuff here in the US. It lowered prices and created more revenue for the US government because, after the 2018 tariffs, the price of solar panels went down, the price of washing machines went down, and the price of US steel went down. The experiment was considered a success. So, what we're seeing right now is a strategic use of these tariffs to get what the United States wants. It's really, really clever. But there's also a different theory about why these tariffs are actually happening. And to understand what's really going on, I want to help explain something called the Triffin Dilemma. The Triffin Dilemma was named after Robert Triffin, who was a Belgian-American economist. In the 1960s, he discovered a really big problem. What he found was that any country that was creating the world's reserve currency, like the US does with the dollar, faces a fundamental conflict. On one hand, the world needs more dollars to allow for global trade and to grow their economies. Cool. But on the other hand, for the US to supply these dollars, it has to run big trade deficits by importing more than it exports, and this creates a long-term problem. The more the US prints dollars and runs deficits, the more fragile the confidence in the dollar becomes. Eventually, other countries start questioning whether the US can maintain its financial stability. Now, Triffin warned that this could lead to a scenario where countries lose trust in the dollar, ultimately forcing the US to choose between providing global liquidity or protecting its own economic interests. Now, I realize how insanely complicated all that sounds, so let me give you a super easy-to-follow analogy. Imagine a world-famous casino where players from all over come to gamble. The casino has special chips that everybody trusts, and soon these chips become so accepted that people start using them for games outside the casino, in their own personal games at home. Now, to keep the system going, the casino has to keep handing out more chips than it takes in, running at a loss so that everyone always has enough chips to play with. But here's the catch. The more chips the casino makes and the more its debt grows, at some point, players might start wondering, are these chips worth as much as they used to be? What if other casinos make their own chips? And what if the other players actually start using them? And that's exactly what's happening with the US and the dollar. Eventually, players might stop using the US chips and switch to another casino's chips. Of course, in this analogy, the casino chips are the US dollars. The Las Vegas casino is the US economy. The poker players are other countries who rely on our poker chips. And the casino running at a loss is the United States running a trade deficit. But okay, hold on. Why then does the US need a trade deficit in the first place? And that's because when other countries sell us things, they get paid in dollars. But those dollars don't just sit there. Foreign governments and businesses reinvest those dollars back into US assets, buying stocks, US real estate, and treasury bonds. Now, this keeps the loop going. The US buys goods, dollars flow overseas, then those dollars come right back into our financial system. If the US suddenly stops running deficits, fewer dollars flow into global markets, demand for dollars drops, and suddenly the whole system starts breaking down. That's why this trade war isn't just about tariffs. It's about whether the entire financial system can keep working the way it always has been. So, how do you fix it? Just keep the players gambling, right? That's how real casinos work. Except the difference is real casinos are taking more from players than they're paying out. That's why they exist. A non-profit casino couldn't last for very long. The United States can't run endless trade deficits without consequences. And here's why. The casino is not making enough money from players because it's giving out more chips than it takes in. That's why you see headlines like this one that the US subsidizes Canada. We don't actually, but we kind of do in some sense. A losing casino has to borrow money to stay open. It borrows money through creating bonds, but now it owes debt to lenders, which are countries buying US debt. And because interest rates are high, it's costing the casino a lot of money to pay those players, which only works when the casino is making money. But this one isn't. So players begin to doubt whether the chips are worth what they used to be because they notice the casino keeps printing new chips out of thin air instead of making real profits. Now, to calm the players down, the US casino's like, chill, we got cool tech stocks, ChatGPT. But then recently, another player at the casino was like, how much are those worth? Because we just recreated that tech for almost free. At some point, the casino reaches a breaking point where it has too much debt and can't keep borrowing money forever. When that happens, players start switching to other casinos that seem more stable. They form new alliances like the BRICS and create their own casinos, which makes the original casino really mad. And if confidence is lost in the casino's chips, their value collapses and the whole system falls apart. And we don't want that, but that's exactly what will happen if the US keeps running trade deficits and printing more dollars forever. It can't do that. As of right now, the US has to keep sending dollars overseas so that the world can use them. And one of the ways we're doing that is importing more than exporting, which keeps the dollars flowing out. That's what you call the trade deficit. And now we're back to square one. The US has to borrow more and more money to keep up this cycle. Foreign countries collect US debt by buying and holding US treasury bonds. The US government keeps borrowing more to fund its economy. And when it can't, it tries to raise taxes, which makes people really mad. So, what's the solution? There's a couple of theories on what the solutions are, like the Plaza Accord 2.0, which I'll explain. But on a personal level, I'm not going to wait around by holding cash because In a world where the US dollar's value is being questioned and the global financial system is shifting, sitting on cash could mean losing purchasing power over time. Now, there's a couple of interesting theories about what the possible solutions are, but one of the most interesting ones I found is the Plaza Accord 2.0. Here's the thing about tariffs. The market right now is freaking out because it doesn't know how long these tariffs will last, which tends to hurt it. If the US suddenly imposes tariffs to reduce trade deficits, which we just did, it could disrupt the fun of this casino. If players are charged a percentage of their winnings as they leave the casino, some players won't want to play. The strongest of players would be like, I'll just make my own casino. But the smaller neighboring players that rely on having fun here are going to be forced to stay here. They have no choice. They might complain about it, but they'll capitulate. And what does the US casino really actually want? It wants a weaker dollar, aka a less valuable poker chip, so it can hand out more poker chips. That's the Plaza Accord 2.0. And believe it or not, this has happened in the past. The original Plaza Accord happened in 1985 when the US, Japan, Germany, France, and the UK all agreed to weaken the US dollar on purpose. The US wanted this. Why? Because a strong dollar was hurting US exports. World leaders worked together to lower its value, and this helped the US stay competitive. That's what President Donald Trump is after. He wants to create so much pressure and so much aggression. We're going to buy your country, right? That it will open up negotiations to weaken the dollar to reset expectations. He wanted this in his first term when he was president by pressuring Mr. Powell into lowering interest rates. But Papa Powell and Mr. Trump don't really see eye to eye all the time. Mr. Trump wants a weaker dollar so that US exports become cheaper, making American businesses more competitive. But Papa Powell, as head of the Federal Reserve, has a different goal. He's focused on keeping inflation under control. He does not care about the stock market. Inflation is his legacy. And that's why he wants interest rates higher for longer. But here's the problem. Higher interest rates make the dollar stronger because it attracts money from all over the world to be parked here. More demand for poker chips. So, Mr. Trump is using tariffs not only as a weapon to create pressure and potentially slow the economy, but ultimately to force Papa Powell's hand into cutting interest rates to re-stimulate the economy. It's a classic Trump strategy. Maximum pressure, maximum chaos, and then ultimately, boom, art of the deal. Weaken the dollar. So, the question is, what happens to stocks and real estate and Bitcoin and all these other assets? They tend to go up. Stocks tend to benefit because lower interest rates make borrowing cheaper, which boosts growth stocks, tech stocks, and high-debt companies. And historically, stock markets prefer when the dollar is weak because companies that export goods, like Apple and Tesla, become more competitive. Real estate benefits because lower rates mean cheaper mortgages, and investors that want to protect their buying power might also flood their money into hard assets like property. Bitcoin and gold are apex predators in the domain of property. That's why gold just hit an all-time high recently. And as fiat currencies weaken, people look for alternatives that hold their value over time. That's what I think the smart investors see. I think that's a really interesting theory. Now, the real big takeaway is that, on a personal level, cash is probably going to lose purchasing power in this scenario. Investors who sit on too much cash while the dollar weakens could see their savings eroded, possibly by inflation, but definitely by asset values going higher. If this theory plays out, we're looking at a future where the financial system changes in a really big way. The US could be heading toward a long-term period of lower interest rates and a weaker dollar. High growth, similar to what happened after the original Plaza Accord. And if that happens, the biggest winners will be those who hold assets. But anyone who relies on things like fixed income savings or an income that doesn't keep up with inflation will unfortunately be left behind. But all this is, of course, allegedly for entertainment purposes only. If you found this breakdown helpful, smash the like button, subscribe if you haven't already. I hope you have a wonderful rest of your day. I'd love to see you back next week. I'll see you soon. Bye-bye.